Dirty dealings, corporate battles, consumer woes. This is Evening 5. Bank Negara said it found rising foreign currency holdings among Malaysian corporates, exporters and importers, resulting in an imbalance that weakened the ringgit in the short run. On top of the call to state-owned companies, BNM Governor Datuk Sheikh Abdul Rashid Ghaffur strongly urged Malaysian businesses from all sectors to repatriate their overseas investment income and convert export proceeds back to ringgit to support the central bank's efforts to manage short-term pressure on the local currency. He said that specifically BNM observed an increasing trend by certain exporters taking time to convert their export proceeds, importers front-loading their purchases of foreign currency, and corporates not converting their overseas investment income. As such, this behaviour has contributed to the imbalances in the forex market, according to Abdul Rashid, who said this during a press conference held in conjunction with the release of the central bank's annual report. Meanwhile, Abdul Rashid also said that Malaysia has a window of opportunity to undertake the necessary structural reforms on the back of steady economic growth projections, coupled with moderating and stable inflationary pressures. These include ongoing and proposed fiscal reforms, development of future-ready workforce through labour market reforms, and the strengthening of social protection programs in the country. The central bank has also called for the expediting of numerous industry master plans launched by the government last year as means to support economic growth. BNM is projecting Malaysia's gross domestic product to expand between 4 and 5% in 2024 as compared with 3.7% in 2023, driven mainly by resilient domestic expenditure with additional support emanating from the expected recovery in exports. The central bank expects wages to increase further in 2024 following a slowdown last year, while the jobless rate will likely remain stable near its past trend. Employment is projected to continue expanding thanks to sustained demand for workers amid the ongoing recovery in tourism-related sectors and external trade activity. BNM has also pledged a monetary policy stance supportive of the economy, even as it flagged potential risks to inflation and growth as the government tightened its budget for subsidies. Sultan Abdul Aziz Shah Airport or Subang Airport will be able to handle 2 narrow-body jets like a Boeing 737 or Airbus A329 by end March, said KLIA Aeropolis head Ranhil Singh. The airport will also see its passenger capacity double by June to 3 million passengers from 1.5 million passengers currently as part of the Subang Airport regeneration plan. Under Phase 1 of SARP, however, the capacity will increase to 5 million passengers in 4 to 5 years and up to 8 million passengers by 2030, Ranhil explained. Under the revised SARP, Subang Airport will see the return of scheduled jet passenger and cargo flights. The airport currently serves propeller-driven aircraft such as turboprops, as well as business jets, helicopters and light and military aircraft. In the immediate term, Malaysia Airports Holdings will install new check-in kiosks and a new dedicated baggage reclaim system at Subang Airport. Ranhil said that there are plans to reconfigure the aircraft parking bays to cater to 5 ATR turboprops and 6 narrow-body jets, and with that in place, jet operations can commence from the second half of 2024. Ranhil also declined to reveal the total cost of works for the revised SARP, except to say that the new operating agreements that were signed on Monday between MAHB and the government would allow for a more structured cost recovery between the two parties. Top Glove Corp's net loss for the second quarter narrowed to 51.19 million from 164.67 million a year earlier, fueled by stronger sales volume growth as customers placed new orders following the depletion of excess inventory. Revenue for the quarter came in 11% lower year-on-year to 550.3 million ringgit. No dividend was declared for the quarter. For the first half, Top Glove saw its net loss narrow to 108.9 million from 332.9 million a year ago, while revenue declined to 1.04 billion from 1.25 billion ringgit. In a separate statement, Managing Director Lim Chuang Guan said the improved performance demonstrates the effectiveness of the group's strategic initiatives in recapturing sales, enhancing quality, cost and efficiency, as well as Top Glove's resilience amid persistent challenges. Lim said Top Glove continues to see signs of market rebounding and believes the business will normalise in due course as glove industry fundamentals remain robust and unchanged. He adds that the group remains focused on executing its strategic initiatives to level up its quality and cost efficiency while leveraging on its strengths to capitalize on emerging opportunities. EcoWorld International returned to the black with a net profit of $182,000 for the first quarter of FY 2024 after 9 consecutive quarters of losses. EWI, which mainly develops real estate in the UK and Australia, posted a $30.82 million net loss in the previous year's corresponding quarter. Revenue jumped 42% year-on-year to $31.67 million, driven by the sale of higher-priced commercial units. According to the property developer, the quarter's earnings were boosted by foreign exchange gains due to the appreciation of the British pound against the Malaysian ringgit as a result of the repayment of advances made by its JV company, EcoWorld Ballimore, and the conversion of British pound-denominated bank balances. According to EWI's president and CEO, Dato' Teo Leong Seng, the group is steadily advancing its efforts to monetize inventories. As of February 29, EWI holds approximately $650 million worth of completed and nearly completed stocks available for sale, with the group's effective share amounting to around 500 million ringgit. According to Teo, sales of the completed stocks are estimated to generate excess cash up to 500 million for the group over 2024 and 2025. He adds that EWI then intends to distribute the excess cash to shareholders and are seeking approval in its upcoming AGM to undertake a second capital reduction exercise to enable the distribution to take place. Looking ahead, Teo cautioned that the ongoing challenges of high living costs and elevated interest rates are suppressing demand from potential home buyers. As such, all launches for the remaining sites continue to be put on hold pending review of their feasibility in view of the ongoing weak sentiment among home buyers and significant cost inflation. Newly listed Mastertech Group's recent sharp rise in its share price has attracted scrutiny from Bursa Malaysia, with the market operator issuing an unusual market activity query to the Malacca-based electricity cable maker. Investors were advised to take note of Mastertech's reply to the UMA query, said Bursa Malaysia. Mastertech was listed on the ACE market less than 2 months ago on January 29th with an initial public offering price of 39 cents. The counter was already rising in February, logging an 88% gain to end the month at 65 cents. Mastertech continued this upward trajectory into March, giving it a month-to-date gain of 74%. The stock closed 20 cents or 21.5 cents higher at 1 ringgit 13 today, giving it a market capitalization of 1.15 billion ringgit. In a separate announcement to Bursa Malaysia, Mastertech also updated that co-founder Dato' Lau Kim's son acquired 10 million shares from the open market. Lau owns an 18% direct interest in Mastertech while having a 55% indirect stake through private vehicle MTPC.